You finally did it. There is money left over after rent, food, and bills. For the first time in a while, you have savings, and then a different feeling shows up because the money is just sitting there, not growing, not building anything, just parked. Here is what nobody tells you. Inflation is quietly running at 3% or more. Your savings account earns less than that, which means the money you are protecting is shrinking in real terms every single year. Saving money is not the same as keeping it. Meanwhile, the S&P 500 has delivered roughly 10% average annual returns historically. That gap between your savings account and the market is not just a number. It is the difference between two completely different financial futures, and most people never cross it. But here's the real question. Not should I save or invest? The question is, what money should stay safe and what money should be put to work? That one question is the entire game, and getting it wrong in either direction costs you years. Saving is protection. Investing is expansion. Saving keeps your life from collapsing when something goes wrong. Investing gives your future self more options when things go right. If you confuse those two jobs, your money starts behaving badly. And most people do confuse them. You invest money you might need next month. The market drops 10%. You panic and sell at the worst time. Or you keep every dollar in cash forever telling yourself you are being responsible, while inflation quietly outruns you. Both mistakes come from the same problem. You never gave each part of your money a job. So the first step is not investing. The first step is your do not touch money. One bad week should not become a financial disaster, a car repair, a medical bill, a job loss. If every emergency forces you into debt, you are not ready to invest aggressively. Not because investing is bad, because instability makes you a bad investor. Start with 1 month of essential expenses in cash, not your dream lifestyle, not restaurants and subscriptions, essential expenses only, housing, food, transport, utilities. If your essential monthly life costs $2,000, your first target is $2,000. That money stays in cash. Its job is not growth, its job is availability. Step 2, clear the financial landmines. High interest debt first. If credit card debt is charging you 22% while your investments earn 8%, you are moving backward. Paying off that debt is not boring. It is one of the highest guaranteed returns available to you. Every dollar of interest you stop paying stays in your hands. Not every debt needs to disappear before you invest. A mortgage at a reasonable rate is different from a credit card. The rule is simple. If the interest rate creates financial pressure, attack it before you try to build wealth beside it. Investing next to high-interest debt creates a false sense of progress. The numbers do not lie. Step 3 is where saving actually turns into investing, and it starts with one question. When will I need this money? If the answer is soon, save it. If the answer is years from now, invest it. That question removes more confusion than any investing course ever could. Your house deposit due next year does not belong in the stock market. The market may be wonderful over decades and brutal over months. Investing is a reward for patience. Your short-term money and your long-term money should not share the same bucket. One is waiting to be spent. The other is being sent ahead to work. When you separate them, your money finally has a direction. Step 4. Choose the first investment path. And this is where beginners get distracted. They think investing means picking the perfect stock, predicting crashes, finding the next big winner. It does not. For most people, the first investment path should be boring on purpose. A broad, low-cost index fund that owns hundreds of companies at once. The goal at the start is not to prove you are smarter than the market. The goal is to become someone who invests consistently without drama, because early wealth is built less by genius and more by repetition. Same day every month, same amount, same plan, no emotional theater. This is called automation. And it is the most underrated wealth tool most people ignore. If you wait until you feel ready, you will delay for years. If you wait until the news feels safe, you will never begin. So automate a small amount, even $25. The first amount is not about becoming rich immediately. It is about installing the behavior. You are teaching your financial life that investing is not an event. It is a bill you pay to your future self. Here is why starting early beats starting large. A 25-year-old investing $5,000 a year at 7% reaches approximately $1 million by 65. The same person starting at 35, same contribution, same return, reaches roughly half, 10 years of delay costs hundreds of thousands. Time is the only advantage the market gives away for free. Step 5. Increase the number. Starting small is good, staying small forever is the problem. A raise comes in, part of it gets invested before lifestyle absorbs it, a loan ends. That freed payment gets redirected before your brain finds a new monthly expense because lifestyle inflation is quiet. It never announces itself. It just turns yesterday's luxury into today's normal. If every income increase becomes a new baseline, your future never gets funded. You do not need to destroy your lifestyle overnight. You need to capture money before your lifestyle expands to eat it. Redirect 50% of every raise directly into investments. Your lifestyle still improves on the other 50. Both things happen simultaneously. No deprivation required. Step 6. Build the full emergency fund while investing continues. Work from 1 month toward 3 to 6 months of essential expenses. Your emergency fund is not lazy money. It is the shock absorber that lets your long-term money stay long-term. Without it, every market dip feels dangerous. Every life event becomes a reason to stop investing. With it, you can leave your investments alone. And leaving them alone is a skill. Research on myopic loss aversion shows that the more frequently you check your portfolio, the riskier investing feels. Losses sting roughly twice as much as equivalent gains feel good. The most successful long-term investors check quarterly at most. Out of sight, out of panic. The machine does not need your daily supervision to compound. Because boring investing only looks weak at the beginning. Given enough time, boring becomes terrifyingly powerful. The people who win are not always the ones with the highest income. They are the ones who built a simple system and refuse to keep interrupting it. Consistent, automated, boring, compounding quietly in the background year after year. The first few years will feel disappointing. You put money in, the balance barely moves. Sometimes it goes down. And you start wondering if this is even worth it. That feeling is completely normal. In the beginning, your contributions do most of the work. Later, your returns start doing more. You are not watching wealth explode. You are building the engine. And most people quit before the engine has enough fuel to matter. They invest for 6 months, see no dramatic change, then chase something riskier. That is exactly where the damage happens because the strategy was never broken. They just abandoned it before the compounding had room to run. Patience is not passive. Patience is the entire strategy. So here is the honest split. 2 people can both have $5,000 saved. From the outside, they look identical. One sees it as the finish line, keeps adding cash forever because investing feels scary. The other sees it as the foundation, keeps enough cash to stay safe, sends the rest into assets that grow, same bank balance, completely different future. Cash protects your present. Investing protects your future. The most expensive mistake is asking one to do the other's job. Protect first. Clear the landmines. Separate short-term money from long-term money. Automate the first investment. Increase it when income grows. Let the system run. The savings account feels safe. But over time, the investment account is the one building the life you are working toward. You do not need to become a financial expert. You do not need to predict crashes or find the perfect stock. You need a starter emergency fund, high-interest debt cleared, a consistent contribution automated, and enough patience to let the compounding run. That system, built by ordinary people with ordinary incomes, has quietly produced extraordinary outcomes for decades. Keep thinking, Stick.